to this week's class. We are going to be talking about financial statements. And before I get started, I think that it's safe to say we are technically kind of moving out of the health policy and kind of the overview of the healthcare financing environment and marketplace, and more into some of the technical skill sets that we will go over in this class. So kind of a shift from what we've been discussing in the past into kind of more of the nitty gritty, I think, what people think of when they think of finance. So we will go ahead and get started. I think it's safe to say that for those of you in the course who are getting an MBA and have taken finance courses in the past or have a finance background, this class should be relatively easy for you. It should be repetitive. For those who are new to finance, it's maybe your first or second class, you haven't taken it in a while, this class will be much more of a foundational base for those students. I apologize if this is repetitive, but we kind of can't go forward in general without going over it. And I think, this lecture really is kind of would be the same if I was, not the same, but there are some small tweaks. But in general, what you're learning today is basically true for all businesses. The financial statements generally are the same. Maybe a few tweaks in terms of what certain line items might be called or certain names of things. But in general, this lecture of the class is kind of the standard of financial statements across various business types and various industries. So with that said, we will go ahead and get started. Just a brief overview. I'm going to start by going over the balance sheet, then I'm going to go over the income statement, and then I'm going to go over the cash flow statement. So that's the order. And before we get started, it's important for, everyone to understand just a kind of a few basic, or kind of this basic concept. So all of these, these financial statements are all guided by, the same principles. And that is why, like I said, but on the, slide back, that, what I'm teaching you today is the same for every business. So in the United States, we, the Financial Accounting Standards Board, so FASB, and the American Institute of Certified Public Accountants, came together and they created the GAAP standard, so the Generally Accepted Accounting Principles, GAAP. And what GAAP says is GAAP creates basically the playbook, the rules, for which organizations and businesses can, not-for-profit and for-profit, how they can record and report various information throughout these three financial statements. Essentially, they set the rules, and based on the rules that they set, all of these statements are audited, on a yearly basis in accordance with the GAAP standards that are set. A lot of people say, some people say that accounting is both an art and a science, and that is certainly true. I think that GAAP wants you probably to think of it as more as a science. But when people get in trouble, when you read the news stories about people getting in trouble for issues with their financial statement or mislabeling things or not being honest in them, it's generally because they did not follow the GAAP standards. And you can go to the website and look it up. Some of the rules are really, really technical, and some of them are a lot more straightforward. People or organizations hire accounting firms and pay them lots of money. These accounting firms are people like KPMG and Deloitte, and some of those big names, Ernst & Young, that you may be familiar with. But they hire these companies, and then there are smaller companies, and they hire them. And these companies employ, a ton of people who all are accountants, and their job is to know the GAAP rules, and their job is to specifically also know how those GAAP rules are interpreted, and when we say interpreted, but how they're generally interpreted and implemented across different industries. And There are certain accountants that specialize in very specific parts of the balance sheet, and so forth. And so it's just, you may hear that. It's important to kind of understand that they're the rule book for which all of these statements kind of play by. The balance sheet. And I think I mentioned this earlier, but for some of you who have taken lots of finance classes, I know there's a few of you in this class, this is going to be very easy. This specific class will be very easy for you. For those of you who have not taken finance, to me, when I was learning finance, this lecture really is the backbone of everything you need to know. And I think if you spend a lot of time learning everything in this specific lecture, then the rest of the class will be significantly easier. A lot of the words that I'll go over today you may have never heard before, so if you don't understand the meaning of a word, you need to go and look it up if I don't define it, if it's new to you. So this is not the lecture to breeze through. This is not the lecture to kind of days in and out of. I would suggest that if this is new to you, it's like a foreign language for many people. Some people get it really easily. Some people, they're just not used to the concepts or thinking about things in the way that financial statements kind of encourage you to. And so if that is you, I recommend listening to this lecture multiple times, taking lots of notes. While I think my lecture is fabulous, if there's something that, go to YouTube and find someone that explains it maybe in the words that you say. There are a lot of extra great resources on YouTube. I don't generally like to encourage my students to go there, but I think you need to find a way to obtain this information. It will make the rest of the class extremely easier. And I think you'll also find that the information that you learned today is very useful and helpful if you want to go and work within an organization and be somebody who is a part of the decision making. So as we get going, that's just one thing to note. So the balance sheet is a snapshot of detailed outline of what the business owns, what the business owes, and what the business is worth. And so there are four key things, 4 key words that you need to think about when you look at this slide. First key word is that it is a snapshot. It is a moment in time. It is not for the end of a period. It's not done for a full year. It is the way that a business looks at a simple moment in time that the document is reported. So if it's reported on December, you'll often see them, as of December 31st, the end of the year, December 31st, 2015. That is the balance sheet for that one day, the end of the close of the business of that day. It is not the balance sheet for January 1st. It's not the balance sheet for December 30th. So it's important. It's a snapshot. It is just a moment in time. It explains what the business owns. It explains what they owe, so who they owe money to or how they are financing what they own, and then it explains what they are worth. So if it's an investor-owned organization, it explains what's the value of the company. There are 3 main parts of the balance sheet. It is the assets, liabilities, and equity. And the formula that you'll hear people say, and it's kind of like, it's pretty easy, but it's assets equals liabilities plus equity. So if you go back and you think about what I mentioned earlier on the previous slide, that this is a snapshot of detailed outline of what the business owns, what the business owes, and what the business is worth. What a business owns is your assets. So it's everything that you own, you legally own, and it's kind of what makes your business your business. Then what it owes is the liabilities, and then the worth is called equity. So if it's easier to think, if you have never heard those terms, assets, liabilities, and equity, That's a really easy way. Those three words are an easy way to think about it. To our formula, that regarding assets, liabilities, and equity, what you own is equal to what you owe and what you're worth. Is a way to think about this. So the thing about that basic formula is that it absolutely has to balance. I will say that again. Your balance sheet, hence the title, must balance. You cannot have more assets than you do liabilities plus equity. But it's also critical to understand that, this formula, it can be moved around. So it can be expressed where equities equals your assets minus your liabilities. And it can be expressed where liabilities equals your assets minus your equity. One thing that is critical is when you actually see this formula, or when you actually see a balance sheet, your liabilities come before equity. And that is because your liabilities are generally paid out before the equity is paid out. So it's shown before that. And that means if a company is closing its doors, it's shutting down, it's filing bankruptcy, you pay your liabilities first, and then you pay out the people who own you. So just one important thing to think about. I came up with Rowdy Raiders X-rays. They sell and manufacture X-ray equipment. So they have assets. They have a total assets of $149. And you can see that there are different types of assets. You have current assets whose use is limited. You have property and equipment, and then you have other assets. And then on the other side of the balance sheet, you have liabilities, $96 of current liabilities and $13 of non-current liabilities. And then you have $109, which makes $109 total of liabilities. And then you have $40 of equity. So if you go back and you think about what we talked about before, all of the assets over here are what we own. It's what Rowdy Raider X-rays owns. The liabilities are what we owe, and the equity is what our company, Rowdy Raider X-rays, is worth. And this is a snapshot. This statement changes every day as a business increases and decreases in assets, which changes its liabilities. This is especially important because many organizations are seasonal, so they have they have times of the year where they're busier or they're kind of more popular. Think about let's think a clothing store. Clothing stores do a significant amount of business in November and December during the holiday season, and they have kind of ebbs and flows. And so, it's important to understand that like a balance sheet for, say Gap or Target, in December will not look the same as it will look in March. And they go through these changes, and that's why it's important to understand that it is an absolute snapshot. The balance sheet is often called the backbone of the organization. And it's called the backbone because the idea is that every single thing that is in an organization will somehow be, linked to a specific subgroup within those assets, liabilities, and equity. And I really like. For me, it's my absolute favorite. A little biased. I love the balance sheet because in my mind, if you want to know anything about how a company is making money, if you want to know anything about, what they're planning for the future or an idea of what they're planning, you go to the balance sheet and you will find something somewhere if you dig deep enough, in those different subgroups that give you an indication of what's happening and what the viability is. And so what it really does is it reports on the assets of an organization and how these assets are financed or paid for. And it's either paid for through liabilities, through, owing people money. Borrow money is considered a liability. Or you have owners that have invested in the company and you turn that into an asset. And lastly, as we explained before, it must balance. You cannot have it not balance. It just doesn't work. So if you're ever, on a finance test and your balance sheet doesn't balance, you have done something wrong. So let's take a step back and think about what does it mean to be like, what is in a company. So, and why do I say that you can find everything in a balance sheet, that you can find every part of a company or a business in a balance sheet. So let's think about the Rowdy Raider X-rays. They sell and manufacture X-ray machines. They're based in Ohio. Surprise, surprise. So this is an X-ray machine. They have these. Some of these are sitting in a warehouse, waiting to be shipped and waiting to be sold. They have a corporate office building where their headquarters sits, and their salespeople use office space, and they own this space, and they have a cafeteria in there, and yada yada yada. Your typical office building. They get cash payments when they sell one of these X-rays. So they have some cash sitting around. They have cash. They also get checks, or they get a check from a company saying we're going to pay you, or some sort of promise note saying we're going to pay you money. In addition, they manufacture these pieces of equipment. This X-ray machine. So here is a picture of their warehouse and all the equipment. This is equipment that they use to manufacture these X-rays. And in order to manufacture it, they have to buy, different raw materials. And here are the raw materials over here in this corner. All these little raw materials, and they order the raw materials. And when they order the raw materials, they get an invoice saying that they need to pay for the raw materials. They have a really large, awesome group of salespeople over here. They're all awesome, sticking their thumbs up, really super high energetic, and they make sure that all of this equipment over here that is built doesn't sit around in a warehouse too long, that it's going someplace and it's being sold. And lastly, they have a board. They have a board which is made up of their equity shareholders over here. It's all the people that own the business, and they meet once a month and talk about, kind of the direction of the business and what's happening and where the sales are going. Now, each and every picture on this page represents something that I can point to in the balance sheet. It's either an asset, something that we own, or it is a liability. It's something that we owe, or it is equity. It's the ownership of our company. And I'm going to try to use this example as I go through parts of the balance sheet, because to me, again, it's easier if you can actually really comprehend that the balance sheet really does represent real live, it represents things in a company. Our first part of the balance sheet is our current assets. So our current assets are assets that are expected to be exchanged for cash or consumed during the operating cycle of the entity. That it's something that, generally it will, has a life, they call it a life of usually at least 90 days to a year. It just depends on, what your business type is. What we will say for Rowdy Raider X-rays, it's a year. So it's anything that kind of cycles through in a year. Our cash and cash equivalents, they consist of coin, currency, available deposit funds at banks, and cash equivalents can include savings accounts, certificates of deposit, and other temporary marketable securities. Accounts receivable represents money that is owed to you from a previous, from a customer for a prior service of good. And there has to be, some sort of binding contractual agreement between you and the customer that allows you to mark this as an accounts receivable. You can't just, if we're selling an x-ray machine, we can't just show up at, a hospital in Cincinnati and say, and talk with a healthcare administrator and say, hey, we want to sell you guys four x-rays, and then say, yeah, we'll probably buy 4. Yeah, that sounds about good. But if there's never, a document signed and really a backing, a legally enforceable claim that they're actually buying, those, and you sent out an invoice to them, then you can't actually mark it as accounts receivable. And then next you have inventory and supplies. So I think that's pretty self-explanatory. It's all of the inventory that you're waiting to sell, or supplies that you're waiting to sell. Next you have assets whose use is limited. So these are generally assets or cash or investments that can only be spent for certain purposes. So they have a very guided use of them. One example would be, in this slide, I have malpractice funds or a bond trustee, but it's something, it could be a form of insurance that you have, that a business has, where that insurance policy, while yes, it's something that adds value and it's something you've invested in, it can only be used legally for certain things. So they call it, whose use is limited. Next, go ahead and go to the next slide. What fits in where? Cash, I think that's really easy. Cash would be a current asset. This, cash that we've received, it would probably go up in our cash, number one. If you got a check from a customer for a x-ray machine, that would go into cash equivalents. An invoice down at the bottom. So you've sent someone a x-ray and you sent them an invoice for it, and you're waiting for them to actually pay you, would go into accounts receivable. And then last but not least, you have our x-ray machine. And this x-ray machine is sitting there and it's waiting to go out, and this would go into inventory/supplies. So this is what I mean, that everything that you see in a business is actually part of the balance sheet, and it's defined somewhere in the balance sheet. So next, under our assets, we have property and equipment. So you have land and improvements. So this generally represents tangible permanent assets, those things that are really like this building. I mean, it's going to be around for 50 years, and you're going to be paying for it over time. You have the building. If you think back to the example, if you are a company that produces things, you may have, a place where the production occurs, a place where you're building. For us, it's a place where we're building our x-ray machine, so we may own that, and we'll put that under buildings and equipment. And if we're building anything, and then allowance for depreciation, this may be a concept that is new to people. So in general, allowance for accumulated depreciation represents the accumulated depreciation taken on an asset to the date of the financial statement. And this is different from a depreciation expense on the income statement, but essentially what it is it goes back to this building right here. And if you think about this building, on the first day that it was built, Everyone's moving in. It's a beautiful office building. It's new. It's snazzy. It's all shiny. But, after 5 years, the building's not new anymore. And it's not snazzy. It's not, sparkly and clean. People have been, working in it for 5 years. And in addition, so the building has depreciated in value. And there's an account set up under property and equipment that accounts for that depreciation in value of what will happen to to our assets, to our buildings. It may be, our manufacturing equipment may have a 20-year life, but over time that has to depreciate because it's not worth the same amount after 5 years as it was on day one. Next, we have other assets. So these are investments in affiliated companies. Let's say, we're an X-ray machine and we have a small, ownership in, I don't know, some other small company that we just like them and they came to us and asked for money. So we have a small investment in another company where we own part of them. Goodwill represents the difference between the price paid to acquire another entity and the fair market value of the acquired entity's assets, less any related obligations or liabilities. So this is an interesting concept, and you actually see it happen. It's really intangible. Like it's actually the part of the balance sheet that I hate because essentially it is, how can I put this in a good example? If anybody has ever bought a house, when you go to buy a house, the house gets appraised. And when the house gets appraised, the house is said to be worth, say, $300,000. But the person that you are buying the house from has said, nope, the house is for sale for $320,000. And you really want to live there. There were other people bidding on the house, and you are willing to pay $320,000 for this house because it's in the location and you just think it's worth it. Even though the appraiser has come back and said, this house is actually, it's only worth $300,000, but you as a buyer are willing to pay $320,000. Well, the difference between what it was appraised for and what you were willing to pay for it, that $20,000, would be considered goodwill. So again, it's the difference between the price paid to acquire another entity and the fair market value of the acquired entity. So the fair market value in my house example would be, based on what your appraisal came back at. That's what they determined to be fair market value. But the reality is that there was a difference between what you paid and that fair market value. So it goes here on the balance sheet. It's considered an asset. And then any debt issuance costs. Next, we go over to the other side. We have our current liabilities. So these are obligations that are expected to require payment in cash during the coming year or operating cycle, whichever is longer. So usually reported anything that's 12 months or less. You have current portions of your long-term debt. So this represents the amount of principal that you'll be paying on any pieces of debt. So when I say debt, a lot of companies, they finance things by borrowing money. And so they take out debt and you have to pay that debt. And so this is the current payment of debt for the next year. You have your accounts payable. So this is, how much money do we owe? If we think back to our example of Rowdy Rader's X-ray machines, do we owe money to our suppliers that supply our raw materials that we then, use to make our X-ray machines? And so that will go in, just like we send someone an invoice, someone sends us an invoice, and we owe money for it. We have our accrued expenses. So we have expenses that we're waiting to pay. So for example, we have to pay all of our, salespeople to, each month and we know that in a year we're gonna have to pay them certain salaries, and we accrue these expenses right here. We may have a construction payable if we're building, a new building or something like that, or if we have something that, if we're doing any construction, we may have to pay for that. We have estimated third-party settlements, so if we're in some sort of a lawsuit, um, where we're expecting to have to pay out fees from a lawsuit, this would go under this third-party settlements. And lastly, we have deferred revenue. So it's revenue that we aren't going to be collecting on for a long time. Then we have our non-current liabilities. And this is our long-term debt. So this represents the amount of long-term in debt that is not due in the next year. So it's, if you remember back up to the current liabilities, we have the piece of our liabilities, that represents the payments for our debt that is due in the next year. Well, this represents the other payments that are going to be due in the years after that. We have more deferred revenue if it's deferred past a year, and then we have any estimated malpractice costs. So, we may know that, someone is suing our x-ray company because the x-ray machine didn't work properly, or let's say they were on it and they got hurt, so they're suing us over it. Or we may just, estimate some expense just in case someone comes forward and decides to sue us. And then we have our net assets. And really, net assets is also called our equity. And this is the difference between assets in the claim to those assets by third parties or liabilities. So this is the ownership. Example of a balance sheet for Harris Memorial Hospital and Harris Community Foundation. Excuse me. So here we have our current assets. So this is, again, what do we own in a hospital? We have our cash and cash equivalents of 82, we'll just say close to $83,000. We have, assets that are limited in our use. So they can only be used for specific things. About $5,300 in 2017, we'll say. We have our accounts receivable. Accounts receivable for hospitals and healthcare organizations are huge. We have $70,000 in patient accounts receivable, so money that we are waiting to receive from patients. We have another $20,000 in other types of accounts receivables that we're waiting to receive from people. And then we have our supplies, which are valued at about $7,000, totaling $194,000 in our current assets. And then we have our assets limited as to use, excuse me. And this is different from here because this is only the current portion. So this is the portion that has to, based on the rules, has to be used in that year. And when I say the rules, again, this is all dependent on what those assets are in the company. Is it some sort of an insurance plan? Is it, again, it's guided by whatever those assets are. But, there's some that are in a not-for-profit hospital that are based on the donor restricted purposes. The donor has said, here's when it has to be used and here's what it will be used for. So they have $84,000 in assets based on that. They have a board designated for specific purposes. So the board has said that this is what, money, we have assets that are to be used only for certain purposes. And then on their asset side, they have assets that are held by trustees under bond agreements of $51,000. And then they have, that less the current portion, which is up here because it's just easier for them to report it like that. So they have $513,000 in assets that are limited to use. Next, they have $563,000 in property and equipment. Now think about hospitals. In general, you will see large property and equipment asset balances on these balance sheets. Hospitals have these huge, beautiful buildings, and they have a ton of equipment in them. Think about all the x-rays. Think about the Da Vinci robots. Think about, the space it all the beds, the space it needs in order to have the operating rooms and so forth. And so, excuse me, it's a ton of significant part of their balance sheet that's being held. And then lastly, they have this other assets account. And it totals about $1.3 million, 1.3 million in their total assets on this side of the balance sheet. Okay, so next we get to the other side of the balance sheet, our liabilities and our net assets or our equity. So as we can see here, we have our accounts payable, so all the money that is owed, that we as Harris Memorial Hospital and Harris Community Foundation owe to other people for services that they provide for us. We have accrued expenses and other liabilities of $58,000, or close to $56,000. We have we owe third-party payers $7,300, close to $7,400. And then we have current maturities of long-term debt of $4,000 or $4,600. So what you can think of in terms of the current maturities of long-term debt, that's the amount that we owe this year in the next 12 months for long-term debt that we've taken out. So it can be, a loan that's a 5-year loan, and it's just the piece of the loan. It's just the amount that we owe in the next 12 months. So that makes a total current liabilities of $103,522. Then we go to our long-term debt, this is, our non-current liabilities. So we get into our long-term debt minus the piece up here, minus this $46.92 up here that we just discussed. We have contingent professional liabilities of $33,000. We owe a broker for some service they provide, $15,000. We have other liabilities of close to $21,000, and then we have post-retirement benefits, obligations, and other pensions that are usually for employees that we owe, like way down the line, because it's post-retirement and they're still working, and so they won't be collecting on it for a while. So these, in general, this part, anything that's not part of this current liabilities is generally older than 12 months, or is due past 12 months, and we get to a total liabilities of $620,427. And then we get down to our net assets, or the ownership part of our balance sheet. And remember, net assets is another term for equity. And I'll explain the exact difference between those two, but just see net assets equals equity. It's the same thing. But we have total net assets of $684,619. Gives us a total liabilities and net assets of $1.3 million. And if you go back to the previous page, that balances with the amount of assets that we have. So remember, just to go over it one more time, the balance sheet absolutely must balance. Liabilities are paid before the equity is paid out, so it's shown before equity is on the balance sheet. That means that all of your debtors, if the hospital was to close its doors tomorrow, all of the debtors get paid first because they have the least amount of risk, but they get paid first, and then everybody in the equity gets paid out last. Remember, you can express the formula in different ways, so equity can equal assets minus liabilities. And lastly, equity can be negative. So equity represents ownership, claims against the total assets of a business. If a business closes its doors, the liabilities are paid first and the equities paid last. So in a situation like that, where you owe more than what your equity is, you can end up with a negative equity situation. And just just to clear this up, when you think about not-for-profit versus investor-owned balance sheets, it's important that there's a difference. The concepts are the same. Don't let this confuse you. It's not, meant to, overall the ideas are all the same. The big difference that you need to know is that for not-for-profit organizations, there is no equity. Instead, this is called net assets. And the concept is that technically, in a not-for-profit organization, you technically do not have owners. The owners really are your community stakeholders. It's the people that you serve, and so that's the people that you should think of as your owners. But legally, there are no owners in a not-for-profit company or organization, so you can't call it equity. It's called something else. It's called net assets. So you should know that when you're looking at a not-for-profit healthcare organization, you'll see net assets. When you're looking at a for-profit, you will see equity. Self-test questions that you should be able to discuss and go into detail on. What's the purpose of the balance sheet? What are the three major three major sections of the balance sheet, and what do they represent? And what's the basic accounting equation? What information does it provide? You should be able to answer these. This could be a good example of a short answer question for a test. So next, we're going to go over the income statement. The income statement is also called the statement of operations or the profit and loss statement, the P&L. It answers the question, is this business making money, or is this organization making money? It summarizes the operations of an organization with a focus on revenues, expenses, and profitabilities. So revenues being money that you bring in, expenses being, what does it cost you to do business, and then your profitability, which is the difference between the two. Unlike the balance sheet, this statement is for a specific point in time. So it reports, either monthly, quarterly, or at year end. Most organizations, if you are traded, they'll do quarterly. Everybody definitely pretty much reports internally quarterly. Whether or not they report it out to the public, is a different story. But most businesses prepare this statement monthly, quarterly, and at year end. And so, this is for a time period versus that balance sheet is for it's a snapshot in time. So it's important to know that difference. So there are three sections of an income statement. There are the revenues, the expenses, and the income. So in our statement of operations, or also our income statement, we have our total revenue. So and this is usually within a healthcare organization is broken up into net, like in these two types of ways. So the first is net patient service revenue. So this is considered revenue that from patients after deductions and gross price. So in terms of the charges, and what this means is that this is what some people call operating revenue. So it's revenue that is directly related to your operations, your providing of healthcare to people. So it's generally comes in terms of patient billings. It's what insurance companies pay the hospital or the physician's office for the services rendered. So it's associated with, the exact. It's associated exactly with, the operations of a hospital. Other revenue, on the other hand, which is the line after that, can be associated with other things. So within a hospital, you can have a parking garage, where people park and they pay for it. You have a cafeteria where people, your employees pay to eat, and also to your patients and their family. Maybe not your patients, but your families. And so that will go under the other revenue line because it's considered, not related to your general patient services or your operating revenue. The next section is our expenses. So we have wages and benefits, which in general, within the expense line in a healthcare organization, the wages and benefits is actually one of the biggest pieces, the biggest expense items in a healthcare organization. And this is because, think about who you have to pay. Think about an inpatient hospital, or think about and when you have an inpatient hospital, people are coming to a hospital to receive 24-hour nurse care. And so they, have a nurse that tends to them. They're there to receive physicians. You have to have a physician in order to bill, in order to provide the service, to have them in the hospital. So you have a lot of people that work in hospitals. And so your wage and benefits tends to be the largest piece of, um, the largest piece, very much tend to be usually about 50 to 60% of all your expenses. Um, you have supplies, so any healthcare supplies that you have to buy within a health, um, you know, needles, gurneys, so forth, all of those items. Um, you have depreciation. So depreciation is a non-cash expense that represents the financial value of an asset that an asset loses over some period of time, which is usually defined by the asset's useful life. So as we talked about on the balance sheet, this is like, the way to think about it is that, when somebody buys a building, they're not going to mark the cost of the building in that one quarter, on their income statement as an expense. They're going to put it on their balance sheet as an asset and then over time, that that item will depreciate, and as it depreciates, you see it come as an expense item, and so you pay for it over time through an expense. And so it's not like, it's really sometimes difficult for people to understand, but this isn't actually like cash out the door per se. Like they didn't, the hospital didn't write a check for that building. Instead, it's an accounting value that's been assigned to that building as an asset, and you take the you expense it over time is what depreciation allows you to do. Next, we have interest. So interest is the expense paid as part of debt financing. So you may owe interest specifically to, that you have to pay, and that you have to mark as an expense. Bad debts. So these are the amount of charges that will not be collected from patients for whom payment was expected. Now, this is interesting because sometimes you'll see this up here under net patient service revenue, like they'll subtract it out of there. Sometimes you'll also see it on expenses. It's just, the rule around it's, they're kind of flexible with where you can put it. And it's usually based on the culture of an organization. But in general, organizations know that they may not get all the revenue that they've billed for. And so they generally have a provision where they expect, historically they know that they're not going to collect on, say, 4% of all of their net, on their collection from payments for patients. And so with that said, they plan for it and they put an estimate that they take a hit on as an expense. And then lastly, you have other income sources. So, you see these a lot in not-for-profit organizations. You see endowments or, like people donating money. So you'll see that come through on the statement of operations here. You'll also see for the for-profits of the world, you'll see, you may see like gains and losses from either sales of property. So if they sold, if they sold a building off or sold a business, they can take a gain from it. Or if they lost money on that business, they'll take a loss there. They'll also, if you have if you have money invested in, say, for example, like some sort of endowment or financial money market, account that your company invests like an endowment in, and this money this account made money, or this endowment made money in the time period, then you'll see this marked here. You'll see this come through on this. Is XYZ Hospital. So you know that it's not the balance sheet just from this single line right here. So what it says is for period ending March 31st, 2015. So this means it's usually March 31st, 2015. That means first quarter of 2015. Excuse me. Oh, I need to change the date, but this is 2015. And you have your revenues. You had net patient service revenue of $4,041. So exclusively from patient care, you have your provision from bad debt. Here they're going to go ahead and report it up here. So this is money that they know that they won't collect. They have net patient service revenue here of $39,960. So that's this 4041 minus the 46 gets your total net patient service revenue that they're going to collect, either have collected or expect to collect, that's related to activities that happened in this quarter. And then they have other non-operating revenue, which again can be from other activities such as cafeteria services, parking garages, etc. And that's $27, getting them to total revenues of $4,023. Next, we have our expenses. So salary and benefits, huge when you think proportionally of the total expenses. But when we go to expenses, we have our salaries and our benefits. So you have $2,714, which again is generally one of the largest expense items. Oh, it's actually on average 70% of all hospital expenses. And then you have supplies and drugs. So this is the cost of all medical equipment used in providing patient care actually consumed during the period. So in general, that $1,042 will be linked to all of the revenue that was documented for that quarter. So it's important to notice that it's not just we ordered 2,000 sets of new sheets this month, so we're going to market. It's actually directly linked to the patient services that were documented for that quarter. Next, we have insurance. So our hospital has an insurance plan that they have in place, and we have to make payments on that, and that's the cost of the commercial insurance for this quarter. We have depreciation. So you have $21 of depreciation. So as I stated earlier, depreciation really is it's what the company amortizes or spreads out when they spread the cost over many years for a building. And so this represents the allocation of the cost over time. It's not the actual buying of a building, within that quarter. And then last, we have interest expense. So this represents the amount of interest paid to lenders that you owe. So when we go forward, we have our operating income, which is the $4,023 minus the $3,883. So this is all of our all of our income associated with our operating, with the operations, day-to-day operations that occurred in this reporting period. Now we have our non-operating income. We have our contributions. So they receive charitable contributions. This is reported here if it's a not-for-profit. And then you may have investments. So you may have income from endowments, money market items, and so forth. And then you get $23 in non-operating income. For a net income, when you add 140 plus 23, so the operating income plus the non-operating income, gets you $163. So a couple of things to note on the income statement. So your net income is the operating income plus total non-operating income. It can be negative. Hospitals, organizations in general, they lose money all the time. It's not uncommon for them to not lose money. It happens to the best of them. Much of the income statement are estimates. So it's important to understand they don't actually represent cash out the door. It, actually represents much more of the activity and the accounting activity that happened in that month. And it's like, so let's say you do have a positive net income. Well, what happens? What happens to that money? So there's really two options. You can pay it out to investors, this is usually paid back to investors through what they call dividends, or instead of paying it out to investors, you can invest it back in the business. You can, put it to the side and save it for a rainy day in case something bad happens. You can turn it around and invest it in a new wing on your hospital. You can save it up. It just kind of depends on, what the business's strategy is at the time. Last questions. You should be able to answer these. Briefly explain the purpose of the income statement and explain the format of the income statement and the different sections of the income statement. These would be adequate test questions potentially. So the last one that we're going to go through is the cash flow statement. So the cash flow statement provides information that shows an organization the cash inflows and outflows. So the inflows are the receipts of cash and the outflows are the uses of cash. Now, let's take a step back. So I think the cash flow statement is it can be a tricky concept to get because it's different than the income statement in that it's actually providing a detailed reporting of what happened what happened within an organization regarding its cash. And it's interesting, historically, they did not start requiring investor-owned organizations to report on cash till 1989. And then not-for-profits didn't have to do it until 1995. And this happened because, the reality is the amount of cash and the way that organizations use cash, so what cash is kind of tied to, is it tied to like a debt payment and so forth, actually reflects a lot of the health of an organization. If for those of you who were, adults during the last financial crisis, liquidity was a big problem. People didn't have enough liquidity. They didn't have enough cash, to cover some of the organizational decisions that needed to be made and processes that needed to happen in order to weather the storm. And so if you didn't have cash, you were stuck. And this cash flow statement is what tells you kind of where all that cash is going and what it's being used. Most companies don't sit around with a bunch of cash, in an account. They take it and they do something. They invest it in something. So they have cash that's paid to them. They have an inflow, and then they have an outflow. They take the cash and they do something. They invest it in something. They make a payment on debt. There's, a lot of different sources and uses. And kind of how they do that is really important, in terms of where their cash is going, because, it can help give an understanding of the actual liquidity of the organization. So, and the concept was that the balance sheet cash account really doesn't give a full picture of what the business's cash position is. Because again, companies don't keep cash sitting around because they can invest it in something. And when they invest in something, they can make money off of it. And so this cash flow statement, allows us to get a better picture of the organization in terms of their liquidity, what's happening to it and how cash is being used and how available it is. Because if cash isn't available and, when it's needed, then you run into major problems and, organizations file bankruptcy and so forth. So this is a big deal. So we'll keep moving forward. If you need to stop and take a break, I think the cash flow statement can be a little bit daunting, so don't hesitate to re-listen to these slides. These are inflows and outflows, and they are generally, the cash flow statement is broken into 3 sections: operating activities, investing activities, and financing activities. And each of these 3 represents a section of the cash flow statement. And, this represents the actual movement of cash. So items you see on this may not be equal to what you see on the income statement, because the income statement represents obligations that create cash flows. It's important to understand that, and in addition, pieces from the cash flow statement, are very closely tied to the balance sheet and also to the income statement. And what's on the income statement doesn't necessarily equal the exact amount that's on a balance sheet or an income statement, because this is about the actual movement of cash, not the obligations, not the accounting obligations, which are different. Our operating activities. So you have our sources and our uses of cash, which are tied to operations. So similar to what I was talking about for the income statement, this is directly related to the operations of the business. So, generally you have cash inflows where you have cash from patient services. So you have the payments coming in from the patient services. You have interest earned. And then on the cash outflow side, you have cash paid to employees and wages. So, we talked about, how do you earn that revenue? Well, you have to pay physicians to come in and provide services, and you have to pay nurses. And so you have to pay them in cash. And so you have the cash outflow of their wages. You have a payment of interest. So if you actually owe interest, you have a payment for creditors, and then you have income tax. All of these represent cash outflows, so money that goes out the door in terms of what you have to pay in cash. And these represent cash inflows, so money that comes in the door. So these would be called a source of cash, and this would be called a use of cash. All of the cash outflows on this statement, or on a cash flow statement, are going to have parentheses around them. So if it has parentheses that it's an outflow, and if it doesn't have parentheses that it's an inflow. Investing activities. So this is cash flows from investments in fixed assets and securities used as alternatives to cash holdings. So again, organizations don't want to sit around with a bunch of cash, because there's other ways to make money on, cash can have money, can be invested in something. It can be, you can buy something with it. And then in turn will earn you money. So it's just like, if you have an individual bank account, are you going to keep a bunch of money in your cash account, in your checking account, or would you rather keep money in some sort of a savings account or some sort of a retirement account? The fact is that, you're not going to keep all of your cash sitting in a checking account as cash, because you don't need access to it all the time, and B, it can go into another account and earn money. So it's the same thing for companies. They have the same concept. So when you think about cash inflows, so sources and uses of cash, if a hospital was to sell a piece, property and equipment, maybe they had an old MRI machine that was 10 years old, and they really wanted to be only have new equipment on, so they actually sold that MRI machine to another hospital in the community that wanted to buy something at a discounted price. It could also be the sale of investments. So let's say a hospital owns an outpatient surgical center, and they decide to sell it because it's they just don't want to be in that business anymore. They'll sell it and take that the money from that sale is considered a cash inflow in an investing activity. On the other side, you have our cash outflows. So you could purchase property and equipment. We could need to buy a MRI machine, and once we've sold our 10-year-old one, we want a new one, so we need to buy it. That requires money to go out the door. It's a cash outflow in an investment activity. And then you could also, let's say we want to buy, we sold off our outpatient surgical center, and we decide that we want to buy a physician practice of primary care doctors. So we buy that and we invest in the primary care. And that would be in our purchase of investments over here. Again, money goes out the door for these two items. Money comes in the door for these two. Cash comes in. Over here under cash outflows, cash goes out. Last, we have our financing activities. So this are the flows that arise from financing of assets and operations. I think these are usually like the smallest section. You can have your contributions, which is donations in. You can have a sale of it if you sell stock. That comes, you get money for the stock that you sold. So it's always interesting if organizations need cash a lot of times, and they want their cash flow statement to look better. They will go and sell. They'll issue additional stock and they'll sell it so that they can get cash infused into their organization, and you'll see it come through in this line item of cash inflows. On the other side, we have our cash outflows, so our cash out the door. We may be paying long-term debt financing. We may owe interest on something. We may, on a financing activity, we may repurchase company stocks. We may have issued company stock before, and we want to buy it back. We have to pay for it. We have to pay people for their stock. And then lastly, the payment of dividends. So, back to if we have a net income and we decide to pay dividends out to our stockholders, it's cash out the door that we didn't get to keep. So it's, again, over here on the cash outflows, it's a use of cash. And over here on the cash inflows, this is a source of cash. Here is an example of a cash flow statement. As you can see, we have our cash flow from operating activities right here. And so we have cash from patient services. We have cash paid to employees and suppliers right here of $36.84. We paid interest. So we had cash outflow of interest, and we also earned interest. So we had money coming in, cash coming in of $13, getting us to a net cash from operating activities of $96. And as we go down, we have the cash flow from investing activities. We have our purchase. We have a purchase of property and equipment. So we had cash going out the door to do this of $25. We purchased securities of $35, so gave us net cash from investing activities of $60. And last but not least, we have our cash flow from financing activities. We were given donations of $10. We had a repayment of long-term debt of $13, which gives us a negative net cash flow from financing activities of negative $3, excuse me. And then, so we have our net increase or decrease in cash equivalents. So this is the sum of the total from the three sections. So if you take the 96, the 60, and the 3, get us to a positive 33. Next, we have the cash and equivalents at the beginning of the year. So, this statement is always presented in the way of where were you last year and where did you go this year in terms of your cash position. And so at the end of 2011, XYZ Hospital had $41 in cash in their cash statement. And then in terms of the cash and equivalents at the end of the year for 2012, that if you take the 41 and you add the net increase or decrease in cash equivalents, so the 41 plus the 33 in the line above it, so 41 here plus the 33 gets us to 74 at the end of 2012. A lot of people compare the income statement to the cash flow statement. And as I said earlier, you won't see the exact like same numbers on the income statement that you will see on the cash flow statement. And that is because the income statement focuses on accounting profitability. It focuses on, what income can you state as that in terms of what GAAP allows you to, in terms of economic profitability defined by GAAP, and what they say you can mark as income at a time. So like I said earlier, with the income statement, oftentimes you can mark revenue even though you haven't actually received it, because you have the expectation of receiving it within a certain time, but you have a legal claim to that revenue based on the activities that occurred in that financial in that reporting period, Cash flow statements, on the other hand, focus on cash viability. It asks, is the organization generating and will it continue to generate sufficient cash to meet long and short-term needs? And these are different questions. I would recommend that everyone be familiar with these self-test questions. How does the cash flow statement differ from the income statement? Explain the 3 different sections of the cash flow statement. I would expect that you'd be able to explain them in detail. And then in your view, what is the most important piece of information reported on the cash flow statement? So, I think people always ask me, which financial statement is most important? And I think it really does come down to 2 out of 3 of the financial statements. The first argument is the balance sheet argument. And a lot of people, I mentioned earlier, it's the backbone of the organization. You can see, you can identify, all parts of the organization somewhere on the balance sheet and so forth. I think it gives people an ability to understand what the bankruptcy risks. So, how much of the business is financed by debt versus equity? Do you have to take out loans all the time to, to finance yourself as a company, or do you have equity, and what's the balance of that? Because you want a healthy balance. Versus the cash flow statement argument is that, really no matter what is reported in the income statement or balance sheet, managers and investors ultimately, they're ultimately interested in how much cash an organization is generating. Cash tells you what you can invest in things. It allows you to be sure that you can always pay what you need to pay when people ask for their money or when it's time to pay. And if you don't have cash, you can end up in a lot of trouble. And also the cash flow statements, it says, can you pay your investors back? Can you pay your dividends when your equity stakeholders expect it to be paid? Or, if you're a not-for-profit organization and you don't have dividends, this statement says, can you increase your mission capabilities? Do you have enough cash to continue to invest in the future, to meet payroll and so forth? So, look, I think that, this is something that, I would expect students, really think critically and be able to critically think about each of these financial statements and come up with an argument as to a financial argument as to why the balance sheet, cash flow statement, or even if income statement is your argument, why you think that this financial statement is the most important. And so, I would think that it could be a potential test question, so I would prepare yourself for it. Pointers. I mentioned this at the beginning of the class, but again, for some people, these statements and understanding this comes very easily. Others, it does not. And do not be discouraged if it does not, and you have to listen to this lecture a couple of times. This lecture is only going to be about about an hour and 15 minutes. So you should have plenty of time to do that this week. I strongly recommend that you learn these statements inside and out. If you understand the difference between the three, what each three does, the different components of them, if you know that when I say asset, I'm talking about the balance sheet. If you know that when I say accounts receivable, I'm talking about, a balance sheet, a current account balance sheet. If you know that when I say, the point is that if you need to know all the different lines and where they lie on each statement, and be able to identify that with the purpose of the statement. And I say that because next week we're going to get into how do you analyze these financial statements? How do you make decisions using this information? And if you have not learned the definitions and kind of the backbone of why these statements are all important and what they each mean, that is going to be a very difficult lecture for you to listen to. So spend some time on this, guys. Learn it. Listen to YouTube videos if you need help. If for some reason the way that I'm explaining it, or if you email me and ask me questions, I can't explain it to you better. This is really the backbone of finance and everything that we're going to be doing going forward. And so it's a lot easier if you learn it now than learn it later. With that said, let me know if anything comes up. And I'm happy to help. If you email me, please email me with specific questions. Again, just a few pointers. Learn it. It's a foreign language. It's fine. I struggled with it at the beginning, and once I really dove into it and learned it like a foreign language, it was a lot easier.